we're going to start learning how to employ some of the strategies that we've discovered a bit earlier in the previous lectures. I'm going to show you how to use some of the most widespread strategies, one of the most popular strategies in the market, and how can we actually analyze the markets also. I'm going to use a more useful technique. I'm going to use more understandable charts because maybe you will have some problems with downloading MetaTrader 5. This platform, maybe you will have some difficulties in downloading it or installing it and trying to do other things. But this platform, investing.com, provides live charts, and they're pretty easy to use, and they offer universal access, and you can use them wherever you like. You do not require any registration, and actually you have everything you need here. Everything is quite clear here also, in terms of prices, in terms of indicators. So what I'm going to show you is two strategies mostly. Today we're going to try to discover what are the two, one of the most famous strategies in the markets. And these strategies are going to include things such as, first of all, we're going to discover events, how to trade on events, the most important events in the markets. And secondly, we're going to understand how can we use scalping techniques. Scalping, that's usually a 5 minutes trade in the markets. 5 minutes trade, that means each of the candles shown here is 5 minutes. So these two strategies are very, very important to understand. First of all, I would like you to take a few notes about the events and what can we do, what can be done when we trade on events. Last time I told you about a few things about what is an event in the global commodities market or in international world market, in the international financial markets. What are these events? The major events in the markets are going to be central bank announcements, interest rate announcements, and employment figures. They are the most important events. Central bank announcements are very important because they are always about money. What's going to be the interest rate, the key interest rate, and this one particular event is going to change, to have some dramatic changes in the market. The market is going to either move up or down after the central bank announces those results. And we can find those events actually using economic calendar instrument, the like of which I told you last time. You go to investing.com economic calendar, that can be found in news column somewhere in the news section on this website. You go to news and try to find the economic calendar, and you're going to filter these events looking for the most important ones. You're going to search 3-star events that are showing the employment figures, GDP figures, inflation announcements, and other really important statistics. So, for example, in the past week, that was actually that started in the early November. Let's start with November the 1st. I think that's a good idea to start with the 1st of November to try to understand what happened right from the beginning of this month. I don't think that there are going to be too many events during this time period, but actually there are a number of really important events that happened during that time. Also, I'd like you to keep in mind that in order to better understand what is happening in the world, we should really employ the general time, Moscow time, because investing.com shows the current time as 11 GMT, 11 o'clock, which is not really useful for us, because we do not understand when was that or what is happening right now, because we live in Moscow and all time is dependent on our ability to go into the markets, to enter the markets and exit the markets. So that means we should really use Moscow time in order to find those most important events. Also, you choose this calendar, like I said, starting from November the 1st. It's a bit slow today, but I think we will be able to do it more quickly as time goes by. So it's it really needs some sort of adjustments in these sorts of activities. It's always about making some corrections and some other important points in here. So I've now found this function, and when I go in to see the events, all events actually that happened from the start of November, I do not need all the events, and I do not need all the countries. I need only the most important countries in the world, because I don't think that Uganda, Zimbabwe, Tanzania are very important in terms of what is happening in global economy and in the international financial markets. I would like to choose all important figures, statistics, employment, credit, and central banks announcements, inflation, and 3-star importance. That's the most important news, that is, the most important events. And just as we did that, we're going to develop an economic calendar for the past 2 weeks, starting from the early November. It's going to show this table, and just in a couple of seconds we're going to see the calendar showing all important events right here. So you see, this calendar contains not only working days but also some holidays. For example, on November the 3rd there was a culture day in Japan. That means no Japanese markets were working actually. On November the 3rd there was a very important event. There was the RBA interest rate decision. RBA, that's the Central Bank of Australia, Reserve Bank of Australia. They lowered their interest rates from 0.25 down to 0.1%. And if you check the figures for that trading pair Australian dollar versus US dollar, you will certainly find some very dramatic changes after that. Also, we can find here employment change figures in New Zealand. They're also very important. Talking about the gold prices, usually gold prices change really dramatically when employment figures in the United States are published. And I told you last time that to trade on events in the market of gold, you should really try to use that very simple strategy, non-farm payrolls. These figures, these employment figures, like I said last time, are published each first Friday of the month. In November, that was the 6th of November, Friday. At 16:30 there was an announcement, and the strategy is how to use that strategy. So next time when these figures are going to be announced, or let us talk about the figures for let us talk about these November. Let it be November the 6th. Let's see what happened back then, because we do not have the actual figures for the future, because it's going to be really difficult to make those predictions. But actually we can go to November the 6th. This is very easy done using these techniques that are offered right here on live charts on investing.com. We should really change that and find this graph with the date on it. It is really, it's going to be a quite slow process to drag these curve over to November the 6th. Yeah, this is November the 6th, and last time I tried to explain to you what what actually that announcement meant for the United States economy. So the strategy, which we're going to call a non-farm strategy, let's name it non-farm strategy. Non-farm means that these employment figures are going to be announced and published for only for manufacturing jobs. That means except the agricultural jobs in agriculture. We're going to trade using non-farm data. So non-farm, you should really, so the announcement comes, like I said, at 16:30. That is actually the time when these figures are going to be announced. But you cannot buy or sell in particular this time. If you do that, you will lose the trade, because the market will start moving right as soon as the data is published. So 16:30, that's going to be too late. That means you should start watching closely the market at something like 16:25 perhaps, or even earlier. Let it be 16:25. So you enter the market at 16:35 and you either buy or sell. You should open two deals, actually. You should open two contracts or two transactions. One is going to be sell, and the other one is going to be the strategy buy, or transaction buy. An arrow that is an arrow going up means buy. An arrow going down, downward arrow, is actually sell. So right at 16:25 you open two deals, buy and sell, and wait until the data is published. As soon as the data is published, the market starts moving, and it's going to move very, very quickly. So in this case, on November the 6th, the market started moving down, and it moved down as far as this. That was a very dramatic change in the market. I think it shows very dramatic changes. It showed really dramatic changes in the market. So here it is. That is a sort of a move that we had back then on November the 6th. And as soon as this price comes down to the lowest position somewhere here, we should close our transaction that was supposed to be sell. That means somewhere here we should put a cross on the deal and close it. What kind of sign can I use in order to show that the deal is closed? Yeah, that's going to be a cross. So here I'm going to close the deal and wait. Practice shows, the market analysis shows, that each time gold price goes up, and it actually is going to reach this same level that when the price of gold started falling down, right here. So it's going to really go up right here. In a couple of sometimes it takes a couple of minutes, an hour, sometimes half an hour. The most not very good thing about this strategy is that sometimes you will have to wait all across the holidays, the weekend, because the announcement comes on Friday and the market closes because, well, the stock exchanges and markets, the financial markets, do not work on Saturdays and Sundays. That means if the market, the price of the gold does not return to its starting point before the announcement of those figures, actually you will have to wait until Monday, when the price of gold is going to start moving again, and it's going to start moving up. And as soon as it moved somewhere up here to the initial point, you close down this deal that was supposed to be a buying transaction. So that's the strategy, which is very useful strategy to trade in the market of gold, for gold futures or any kind any other gold assets actually that you can find. This is a very, very easy strategy, one of the easiest strategies in the market. And this usually takes just a couple of minutes or just a couple of hours to trade. So it's going to be it is very risky sometimes, and you get nervous, but usually when time goes by and you've got more experience in that, that is going to be really helpful, and many people profited using just this one strategy. Also, another important event that we happened to see in the economic calendar was Australian dollar to US dollar currency pair, Australian dollar, US dollar. Let's see what happened when this announcement came, when the Reserve Bank of Australia made an announcement, an interest rate announcement. Let's see what happened then. So that was, like we've seen before in the economic calendar, it was on November the 2nd, if I'm not mistaken, or November the let us see when was it exactly, so that we do not make any mistake here. The problem about the investing.com website is that it is usually, when some time comes by, time passes by, and you will have to start everything right over again. So it's not very, very convenient in its use, and you will have to reset to make all these settings once again about the filter instrument and about other sorts of filters that we use, the country filter and the most important events filter, time zone filter. So these things we lost them already, because it's going to be all the time like this. It's not very convenient, but still, yeah, that was, I think that was on November the 3rd. Yeah, that was on November the 3rd at 6:30 a.m. Moscow time. And if we look back to our chart of Australian dollar and versus US dollar, what happened on November the 3rd at 6:30 a.m., I think we're going to see some very important changes, because, like I said, interest rates announcements are always very important events in the markets, and they cause dramatic changes in the market combinations, but actually this strategy, this thing, to use this strategy to trade on events, something like this is going to be very, very risky in times of coronavirus and in times of economic crisis, because markets started really behaving too aggressively and too unpredictably. So for us, for the traders, this is not going to be very, very profitable maybe, or it's going to be very, very risky for them to use this strategy, and for us as well. So interest rates announcements are very useful events for traders because they cause high volatility, and high volatility is always something like traders usually try to use. Let's see what happened with Australian dollar, and we're going to see that right in a couple of seconds. So we have to wait until this chart is downloaded and is shown, is depicted right here, and we're going to see what actually happened back then on November the 4th, 2020. Sometimes what is happening on the markets during such changes in the commodity prices or in interest rates is a very, very interesting thing, and it's very volatile sort of markets. They are usually very difficult to predict because we really do not know which way the market is going to move, and sometimes it moves quite contrary to all expectation, and usually people trade during the announcements of these figures. They buy into the market. So before the announcement about the interest rates, investors or traders try to buy into the market and close their positions just after a few minutes, a couple of minutes, maybe 1 minute or even 2 minutes. If you wait longer, you could have waited longer during good times. Before the coronavirus, these figures were much more predictable, and the market movements were much more predictable, so people tried to buy into Australian dollar, and they waited for an hour, maybe half an hour, until the market stabilized, and then they just closed their position, and that was it. But these days things started really, really nervous, and in times of crises like this, which we experience right now, are very difficult to trade. So I finally can display this AUD, Australian dollar versus US dollar currency pair, and we're going to move onto a 1 hour chart that is going to show what happened actually on November the 4th when this announcement came. Australian dollar and other major currencies of the greatest economies in the world, including Great Britain, Australia, New Zealand, Switzerland, Japan, Canada. Their currencies are the most traded, like I told you last time, and their currencies are mostly when you try to trade on the markets, these currencies are most important and highly volatile. Also, the major amount of the overwhelming majority of all trades happens actually in these currency pairs: Australian dollars, New Zealand dollars, Swiss francs, Great British pounds, American dollars, of course, Canadian dollars, and Japanese yen. And of course, the currency of the European Union, the euro. That is going to be the most important things. So, if you look what happened actually on November the 4th with Australian dollar, you see this downward slide. So, as soon as the Central Bank of Australia made an announcement about interest rate decision, and we've seen that interest rate decision, they actually lowered their interest rate down from 2.25% down to 0.1%. That's almost 0 percentage point. That means the Australian government and the Reserve Bank of Australia in particular are very, very uneasy about what's going to happen with the economy during the pandemics. And that means they expect more troubles to come, and they do not want to destabilize their economy. They do not want to undo the stimulus packages they provided already, and they would like to offer more help to their local markets, to their economies. So that means they're going to keep the interest rates as low as possible in order to stimulate economic activity, in order to stimulate people mostly to spend their money, not to save it in banks. And usually it works. Today's times are not very usual, of course, they're not normal. But the general pattern of this situation is quite understandable and quite easy to analyze. So what we see here, like I said, is the market went down first because as soon as the announcement came and investors saw this new figure, they thought that it is better to buy into the US dollars, and that was the reason why actually Australian dollar started to climb down, because investors rushed into the US dollars. They started buying US dollar in bulk. Later, you see that the market recovered and it gained everything it lost just in the following couple of days. Today, Australian dollar trades at 72 cents actually against the US dollar, and that's the price of it. So actually you can use this strategy, the one I tried to explain to you when we've seen the graph for gold market, the price of gold, and that was quite interesting to see that the strategy actually worked. And I think in this particular example it could work as well. Well, fortunately or unfortunately, these things do not happen all the time, Usually when we analyze markets, we use technical analysis of the markets, and actually sometimes markets can be very, very surprising, and they do not behave like we want them to behave. Despite all those techniques that can be used to analyze the markets, sometimes something may happen that is very unpredictable, and it may lead to drastic consequences and actually to a disaster for investors, for some traders. The technical analysis is always based on the history analysis. We should look into the past few months or weeks to see what happened in a particular market, and then make that decision, something of the sort. Let's return to our gold market and try to see what we can do about the second strategy, which I also wanted to describe to you, about scalping. So the scalping strategy is a very short-term strategy. Usually you got to look into the markets in very short period of time. Usually it's 5 minutes time frame. It's not an hour, it's not 15 minutes. Usually it's 5-minute chart. So when you trade on the market of gold futures, for example, like in this particular case, the contracts for demand, CFD contracts, and we use this 5-hour chart in order to trade the markets, in order to buy or sell an ounce of gold or a lot of gold. Actually it depends what are you going to buy or sell, and it depends on the amount of the account that you have, the amount of money on your account. So first of all, when you try to make that market, that strategy work for you, you got to understand that this short time strategy, this 5-minute strategy, starts with the analytical framework that is called Fibonacci lines, like I told you last time. This is very important to see where was the impulse, the last impulse on the markets, and usually in order to understand where was it, we should go to a daily chart, because those levels, those Fibonacci lines, can be established only in longer term, using longer term charts. So we cannot use a 5-minute chart in order to understand the price movement in the market of gold from last time. And if you remember last time when we analyzed the market of gold, we decided that the gold price was going to rise, and here you can see that from Thursday the price of gold really gained a little bit. It started rising again, and actually that is very important for the gold market today. That means the price of gold may actually go up as high as early August figures. So in order to construct those Fibonacci lines, this is called Fib retracement on investing.com live charts, and you're going to construct those Fibonacci lines right here. So it's done like this. For some reason nothing happens on my chart. Let's try it again. So Fibonacci retracement. I need this particular chart. Yeah, here it is. I'm going to undo it once again because I do not need so many Fibonacci lines in here. So once again, I construct Fibonacci retracement. So you see, this is this figure. These Fibonacci lines are going to show us the probable levels that the price of gold is going to move in a couple of weeks or even months. You see here it's a very colorful thing on investing.com, and you can see that actually those lines are somewhere here. They show real price changes in the price of gold, starting from early August all over to November, to early November and to mid-November, where we are here today. When we've constructed these Fibonacci lines, we should go to 5-minute charts, and we're going to see where we are today, because we're going to trade here and now on this market, and we're going to see what actually happened right here. We should find our Fibonacci line. And where was it actually? Sometimes it is helpful to make smaller this chart, to scale it down a bit. Perhaps that would be much better if we use that thing, if we a bit scale down it. Here in this example, in this chart, the price scale and time scale are actually already done for us. So that's going to be a bit difficult to understand where we are on this 5-minute chart. But still, what you can see here is today, for some reason, this chart is really slow. For some sorts of reason, the internet does not allow us to use it really quickly. That's why we have these difficulties in explaining a number of things that I wanted to explain. Perhaps we should really use some other chart. I'm going to show you another platform, because it's really going to cause us lots of trouble. I once again would like to show you my screen with another chart, and that's going to be more easy and more quicker to do. So here in this chart we once again see the price of gold starting from somewhere from the early November, and we're going to do the same thing like we did last time and the previous graph. So this is the price of gold, and I'm going to use again the Fibonacci lines in order to do that. I'm going to use a daily chart. That's the same graph actually, because the price of gold is the same everywhere, and I'm going to construct the Fibonacci lines right here and show you how it works. So this is it. I return to 5 minutes charts, and here I can see where my Fibonacci lines are. Yeah. So the closest Fibonacci line for us here is this one, 23.6, and the price of gold that is set at this Fibonacci line is something like 1900, a little bit over than 1900. So this is the target the price of gold is going to strive for in the next couple of weeks or even days. So it's going to move somewhere up here. If the price of gold breaks through this line, it may go even further, it may go even higher, as far as 1935. That's going to be the next goal for the price of gold. Also, it may go down because everything may happen, and the closest target, I think, I cannot see this, but it's somewhere below 1860 or 1850 even, so somewhere down there on this chart. And what I'm going to do also, I'm going to increase the scale once again, and I'm going to employ the techniques that we used last time. One of the major techniques that we use to trade using this scalping technique is moving average. Moving average is a very important technique, and we usually use two moving averages. The one is a 20 moving average, that is 20 periods, 20 candles. It's going to be this fat blue line, and one more moving average that's going to take 50 periods, 50 candles, and I'm going to make it red. The strategy that we're going to employ, which is called scalping, let's call it right here. This strategy, scalping strategy, uses this sort of technique. So you got to see this. You got to look for opportunities. Either you buy or sell when you see these moving averages. If blue moving average 20 is lower than the red one, then we consider only selling strategies, selling deals. If we have a different situation, if the blue line goes over the red one, we consider only buying strategies, buying deals. So we never sell when the blue line goes above the red line, and we never buy when the blue line goes under the red line. That's the rule here in this particular strategy. We also got to see that sometimes what can be very important also to try and see through this strategy is to employ MACD. So when should we close our transactions? Because you see that the price is moving very, very dramatically. Sometimes it is up, sometimes it's down. So when we should enter, when should we exit the market is also very important. And in order to understand when that's going to happen, we should use the technique, the indicator that is called MACD, moving average convergence divergence. For example, if somewhere at this point I started selling, somewhere here for example, I started selling, where should I exit the market? That is the question. I should really exit it when the market is going to show a convergence, when MACD should show the convergence. And where is it, this convergence? Or it should not show the end of divergence. So the market may show divergence but not convergence in this sort of thing. In order to see what is convergence or divergence, we should connect the minimums in the market and see whether this is going to, these figures, these lines are going to converge or diverge. In this particular example, I see that the market diverges here at this point. What about this? Situation, this example. I cannot see that here is a sort of a convergence or divergence. So MACD in this particular case is not a very good instrument to really judge this whole thing. And also, what is very important to understand in this strategy is that you see, we cannot use this strategy and sell at this point like I wanted you to sell at this point, because we did not see any tests. What is a test for this strategy? A test is when the market price goes in the area between the red and blue line. The test for this strategy began somewhere here at the price of 1874, and later it started just moving this way, and this test came somewhere here, yeah, but later these lines crossed again, and I lost actually the opportunity to buy or sell, because each time these lines cross, I should reconsider my positions. I should reconsider what actually I should have done. If we look at this kind of development here in this market, so at this point the price of the moving averages, the blue and the red line, crossed here again, here, somewhere here. The market started moving, the price of gold started moving up, and then we see this test here. And where should I actually buy? Where should I start buying using this strategy? I should really buy somewhere here. When the test is over, and there appears the first candle, the first bullish candle after this strategy was tested. It's somewhere here. At the price of 1868, I should have entered the market. I should have bought into gold. Yeah, and where should I exit the market? Let's see. What about convergence and divergence? I again connect the maximums of MACD and the market price. And what do I see here? I can actually make it to scale it, make it larger in order to better understand what happened in, here. And what I see is there is actually it's very difficult to see here. It's again, sometimes this technique is not very useful, and it is very difficult to understand also, and especially when the price started moving back again, down again. At this point, a test number 2 began, so to speak. Test number 2 stopped somewhere here, and the market, the price of gold did not break through the moving average 50 through the red line. That means it was not going to fall down further, and it started moving again, and it moved up all the way up to 1990. Actually, that was a very successful strategy here at this point. So if you bought somewhere here, and if you exited the market somewhere here, you would gain 2,000 points. That is very that is a very lot of money. If you buy into one lot of gold, you would get $2,000 just from this strategy, and it happened from November the 9th, 2140, and the strategy, you exited the market on November the 10th, 9:05 in the morning. So 12 hours of trade and $2,000 in profit using this strategy. Let's see what MACD showed us at this particular situation. was there a convergence or a divergence? These are two maximums with the price of gold. This price is lower, this candle, this maximum price is lower than that one, and MACD shows us, what does it show us? Once again, let's see what happened here. Yeah, that's a clear divergence. It's a clear divergence. These lines are going separate ways, and we should actually exit this market somewhere here at this point, because later the price of gold started moving down, and it would have killed us if we stayed in the market for longer, because it went down as far as this for some very the reasons for it may be very, very different, and we do not know actually what was behind those moves. The market is a very volatile thing, and it may be very difficult to predict. Even most experienced traders make mistakes on days such as these, when this high volatility is up. Also, what can we see here? For example, you did not exit the market here. You wanted to wait, and you became really scared after a couple of hours when the market of gold started going down, and you felt this nightmare. That was very, very dramatic situation. But then suddenly the price of gold touched at this point, and this point is called a local support point. That means we've got this line that shows us a sort of support that is a sort of a guarantee that the price of gold is not going down further. So it stopped somewhere here, just like it did previously. And after that, you may have some hope for gains, more gains in the market. And that's actually what is behind this strategy. So if you did not do this here, if you did not exit the market at 1890 and you waited, you should not really panic and wait for a change in the gold price. And it really did change. After that, it started rising again after this local point support, and here is where we are now. At this point, we actually should exit the market, because we do not know what's coming next. And well, ideally, of course, I should have exited the market here at this point at 1890. And the technical analysis of this strategy showed very much profit in my example. That was a very successful strategy. Let's see what also there I bought, but here I see this huge slump in the market. Something happened very dramatic. And that dramatic situation was, could it be predicted this way? In order to understand that, I should go to H1 time frame, and see where we are. About let it be an hour's an hour's trade time frame. What happened there? What was it about this situation? Can we have expected this slump with the technical analysis? What the convergence or divergence tell us in this particular example? If I connect these maximum points on the graph, and if I connect the maximum point of MACD, I see the divergence. So these lines are going separate ways, and that means somewhere here I could have expected a slump in the price of gold, and actually it really did happen. There was a very huge slump in the price of gold after the convergence, after the divergence thing happened here. This is a very, very important technique. These divergence, convergence, and moving averages also are very useful things. Here at this point, the price of gold touched a sort of a local support point. It touched the Fibonacci line somewhere here. You see that Fibonacci line is close to 1850. So this is the price of gold, and it touched once again. That means it is a very strong support for the price of gold in the October-November period. Last time it did reach that local support point in late September, September the 24th, 25th, and 29th. That was a very strong local support. Then it happened once again in November. And now the price of gold, like we've seen recently, is going up. And this is if the price of gold breaks this line, this Fibonacci line, which is somewhere 1900, if it breaks it, 1902, then it may go up even further, up to 1935. Actually, at this point, like I said last time, I do not change this. I'm not going to change my strategy and my prognosis for the price of gold. I think that we should have bought last week into gold, because I feel like it's going to rise even further, and it's going to break this 1900 line and go even further up. So this is the strategy which we use. We use today two strategies. Usually, what is the most preferable strategy? Either it's going to be an event strategy or the scalping strategy. An event strategy, like we've seen with the gold example or Australian dollar example, it is very risky and very scary, because the market, after you enter the market, the price of gold or the exchange rate of a currency starts moving really quickly, and your account is going to change also very quickly. They're going to be either minus or plus on your account, the profit or loss, and it's going to be very uneasy time for you if you're going to wait if you're going to look what's going to happen next. For many people this is very scary, and then, like I said before, during the pandemics, I witnessed lots of examples when prices started moving very, very dramatically on the news announcements, especially the central bank announcements. Previously, before the coronavirus, everything was quite okay, and the prices were quite predictable. So as soon as the central bank made an announcement, the market reacted quite predictably, and people bought into the market and gained. But when coronavirus came, starting somewhere from March, things started to be quite unpredictable. Central banks made announcements randomly, absolutely randomly. They sometimes met even on Sundays to make an announcement when the markets did not know. This was done, for example, by the New Zealand Reserve Bank somewhere in April. They were supposed to make an announcement on Tuesday, but they did an announcement on Sunday when the market was asleep, so to speak. They did it because they knew that after they made an announcement, the market was going to move up or down. They wanted to, the government, the Reserve Bank of New Zealand wanted to think the better of it, and they met on Sunday when the markets were closed and made this announcement secretly. So when the market opened on Monday, that was quite a surprise for them, and the movement of the market was detained, so nobody really knew what to do next. And other examples also show huge deviations in the market during the events announcement. I also witnessed one very, very dramatic situation in May, on the 11th of May, when the Reserve Bank of New Zealand announced its interest rate, and that was a very dramatic situation when the market started moving up, and many were enlivened by this thing because many people bought into the New Zealand dollar, and the price started really moving very quickly up. But later, just in 2 minutes or even less, there began a slump in the market, and it was so dramatic that just in a matter of seconds everything collapsed on New Zealand market, New Zealand dollar versus American dollar. That was a very dramatic situation, and it made a lot of pain for investors who did trade on that day back then in May. A bit earlier, 2 days before the announcement of the New Zealand Reserve Bank, there was an announcement by the Bank of England, and they decided to keep interest rates unchanged, and the market reacted very, very quickly, and many people actually did not expect that the market was going to up really strongly and stabilize at a higher point. That was a very surprising situation, because previously, when the Bank of England made the same announcement a month ago, a month previously, before the May announcement, the price, the pound sterling moved a bit up, but later it came down and continued its general pattern. It has developed ever since the start of the period. So that was very unpredictable, a very unpredictable situation. And of course, the most important announcements come when the United States Federal Reserve makes them. The Federal Reserve is the most important central bank in the world, and usually they do that later, somewhere in the mid-month. Actually, you got to consult economic calendar on investing.com to see when the Fed makes announcements. And as soon as they make it, that is usually in Russia, it's going to be somewhere 8:30 or 9:30 p.m. They make their announcement in later in the evening, actually, and the market is going to move up or down in the evening. And if you follow the markets during these periods, you will have to go without a slip during that period of time if you want to trade on the events such as these. And also, a very important thing to trade in is the price of oil and gas. Mostly, of course, people are trading using the price of gold and the price of oil, because they sometimes go together. They move in the opposite directions. So they move together, but they move in opposite directions. If there is an increase in the price of gold, that sometimes means a drop in the price of oil, and vice versa. This is what usually happens on these commodity markets. What has very close dynamics to the price of gold is the price of silver. Silver is not very interesting commodity on the financial markets, but sometimes it shows the same dynamics, just like the gold price. Today I think it's something close to $20 an ounce of silver, and we have the price of gold, which almost touched 1900 recently. So I think that's going to be the information I wanted to tell you about the markets, these two strategies, and actually I find them the most useful strategies on the markets. There are many other strategies that can be used as well in these markets, and usually they are done, they are used quite separately, or quite sort of in a quite similar ways. Usually what they do, those prices, they move really quickly, and sometimes it gets really scary when you have to participate in the market. We have 5 more minutes, dear students, and I think if you've got any questions, then please feel sure to ask them.